This one is harder than the others. It's about complex balance sheet preparation. We have 600,000 assets, we have 250,000 liability, and 350 equity. This was the initial balance that was given in the question. The question is also telling us a $20,000 customer deposit was recorded as sales revenue. It is also telling us that there was a depreciation expense of $15,000 and that was not recorded. And there was $10,000 dividend declared. That was also not recorded. The question is asking us to correct it to assets, liabilities, and equity. Let's do it together. Now let's start one by one fixing the misclassification. The first one, the customer deposited $20,000, but it was incorrectly recorded as a sales revenue. So here, think about it. The customer gave us $20,000, but we did not provide the service yet. For accrual accounting, it cannot be considered revenue yet. It needs to be unearned revenue, which is a liability, an obligation to perform. So we just need to reverse the initial thing. Remember, there was a $20,000 recorded as a sales revenue. It is an equity account, so equity was incorrectly increased by $20,000. We are decreasing equity for $20,000 to correct this one. And the second thing is unearned revenue. Previously, we did not put anything there. Now we are creating this liability account because we have this obligation to perform. In the end, our liabilities increase $20,000 and our equity decrease by the same amount. Here is the impact. There is no change for the assets yet. Okay, so the second adjustment was about unrecorded depreciation expense. In the question, it told us that $15,000 of depreciation expense was missed. The key here is to understand the dual impact of depreciation. When you record the depreciation, it reduces net income. Then from there, it affects the retained earnings. That means it affects the balance sheet. So depreciation affects both income statement and the balance sheet. So basically, what happened by missing the recording $15,000 depreciation, both assets and equity was overstated. So the correction we need to do, we need to record the expense, and from there we are going to record the accumulated depreciation. We are going to reduce equity for $15,000 and also the assets for $15,000. Okay, the last part of our question was about unrecorded dividend declaration. In the event, it said the company declared $10,000 dividend payable on January 15. Here is the general rule. The liability is created on the declaration date. Whenever the company says we are going to pay this dividend, on its books, it becomes a liability. So that means we need to increase the liability for $10,000. The second effect is going to be on the equity amount because dividends is a contra equity account, as you know. So it is going to reduce the balance by $10,000. And you can see here there's not going to be any change on the assets. So the correction we did here, just to repeat, we recorded the dividends payable on the declaration dates. So this also can come with other questions. Dividends are reported on the declaration date, not on the payment date. And here is our solution. Initial asset number was $600,000. We made $15,000 adjustment, so the correct amount is $585,000. We did some liability and equity adjustments, 280 and 305. The hook here is that the accounting equation must balance, and when you look here, everything balances. Therefore, the correct answer is A.